Good morning. Welcome to Market Monday. Well, the stock market goes up most of the time, but not all of the time. Taking a look at just the positive return years, we see there are a lot more of them than the negative return years. Since these are returns from 1926 through 2022, this encompasses plenty of recessions, geopolitical tensions, inflation, rate hikes, rate cuts, technological revolutions. It's all there. And despite all of those challenges, the market, more often than not, finds its way higher. To that point, for over a year now, the headlines have been dominated by doom and gloom. There's been a recession on the horizon for the past year, fastest hiking cycle in history, most inverted yield curve in history, leading economic indicators, LEIs, tanking, firmly in recession territory for a while, and investor sentiment is in the tank. This JP Morgan survey shows 95% of respondents think the S&P 500 will be lower than it is today in a year. 95%. So in the name of context and balance, here's some evidence that shows why the market could continue to surprise to the upside. The January barometer, when the S&P 500 is up in January, the return for the remainder of the year was much higher at almost 12% compared to just over 2% when the market was down in January. And when the S&P is up more than 5% in January like this year, after a down year like last year, only happened 5 times in the past, but the full year was never down, with an average gain of almost 30%. Ned Davis research is a rare signal that again only triggered 5 times in the past and just recently triggered for the 6th time. 12 months later, the market was never down with an average return of almost 19%. You can see that while nothing is perfect, these green dots do seem to mark the beginning of a trend higher in stocks. How about the S&P 500 staying above the December low for the first quarter, like it did this year? The rest of the year was higher 92% of the time. Remember, 2023 is on this list, and just look at those full year returns. The worst years were flat and down less than 1%. What about when the first 5 days of the year are up more than 1%? Up 87% of the time for an average of 15%. This may seem like voodoo, but look at when the first 5 days are lower. Just data and context, folks. You're not tired yet, are you? When the S&P 500 gains more than 7% in the first quarter, it's never been down for the year, never, with an average gain of over 23%. And today, we'll wrap with a familiar one, the midterm election year. Larger pullbacks than the other 3 years of the presidential cycle like we saw last year, but since the midterm election year low, that would be October 13th of last year, the market was never lower a year later, with an average gain off the low of over 32%. No predictions, just history and context. Any one of these by itself could be random, but put them all together and it paints a picture that we should at least be open to further upside surprises this year. Thanks for watching and have a great week.